So we'll go into the retirement calculation soon. But first, let's go over what internal rate of return means. And so the internal rate of return is a way to make comparisons against investments based off of present value of cash inflows and cash or the net present value and initial investments. So the internal rate of return is a great metric because it actually uses the net present value in order to determine what our IRR is. And we have a really simple calculation, right? We just press equals IRR B3 through B6 or whatever the cash flows are, and you'll get your internal rate of return now with Excel or Google Sheets. So highly recommend using these tools because it used to be you get a financial calculator, have to put a lot of different inputs here. You just lay out, here's our different years and what's our IRR. It just equals IRR, great calculation. And so what does this tell us? It tells us what is the discount rate we need in order to make our money back. So this is just backing into that discount rate or the rate of return or the hurdle rate or whatever you want to call it. It tells us what we need to get in order to make this a worthwhile investment. So if we had an IRR, it's an IRR 12% is what this project is giving us. And so we can compare that to other projects to determine that discount rate. So it's backing into that rate we've talked about earlier. So you don't need to worry about computing the present value factor if you use Google Sheets, which I highly recommend. Otherwise, you have to go use the factor. I'm not going to go into that into too much detail because you should have covered that in financial accounting. If you need one-on-one help for that, I'm happy to go into more detail. So compute present, and you can look at the present value factors on the other video I have. So internal rate of return, compute the present value factor of the investment project. So here, if you did compute the factor, it would be 2.4. Then you'd have to go to the sheet, calculate it. I'm not telling you can skip all that for this class. There's uneven cash flows that might throw things off. It's best to use a calculator or a spreadsheet. That's what it's saying here. So it's even recommending using the spreadsheet because the factors make it a lot more complex. So I'd recommend not using the factors again. Try to use the sheets. And then we determine what our internal rate of return is, what our cost of capital is, and then we decide if we invest or not invest. So the idea here, we can go over a few different investments. So let's say the company wants, and it has an internal metric that says we want a 10% return. Right? And our IRR for the below is 12%. Are we okay? We can say if this is greater than 0, then yes. If not, no. And then yep, we're okay. So we can play with this. What if we make an investment? Let's make it more fun. Let's say we buy a home. $1 million home. And we know that buying the home will save us rent down the road. So let's say we're investing in the home. But this is a good rent versus buy decision. So Bay Area, $1 million home is not going to get you much, unfortunately. But let's say you bought $1 million home in the Bay Area, and let's say your rent normally is, let's say $2,000 or $3,000 a month for a similar home. Rent is $3,000 a month. But after your mortgage, let's say your mortgage on this, you get a good rate, you put a good down payment or whatever, and your mortgage is $2,500 or $2,000 interest. The rest you're paying into the home, so you're not too worried about it. And so you're saving $1,000 a month or $12,000 a year. A year times 12 month savings. And let's say we know that we can invest in the stock market and get a 6% average return. So then we'd look at, okay, what is our IRR over the next, we could say 30 years if we save this money. So we know our cash investment up front. We'll make a 30-year here. And then we'll just say we know we're saving $12,000 a year. And our IRR, we're going to have to move all the way to 34. So IRR here, our savings aren't enough. We're still having a big loss. It would be better if this is the circumstances for us to have invested the money in the stock market, let's say. But let's say this is assuming we bought the home up front. Let's say instead we put $200,000 down, and then we had a situation where we're saving the $1,000 a month in the difference in rent, and maybe it's like tax advantages. Still, we're getting an internal rate of return of 4%, but we could still make more in the stock market, right? And so this is how you go and decide, hey, if this makes sense from a purchasing decision. And what people will do for real estate investment is do this kind of calculation and compare, what if I buy in Arizona? What if I buy in Los Angeles? What if I buy in Texas? And they'll buy where they get the biggest internal rate of return. So this is a tool that almost all investment analysts use. So feel free to play with this calculator and use it for your tests. And so let's go. This is just a summary of all the tools we talked about. So we have the payback period, the accounting rate of return, the net present value, internal rate of return. So everything's a cash flow basis. I want you to memorize this table. Everything's a cash flow basis except for the accounting rate of return, which is accrual basis, which this is income. The measurement units are years for payback period, percent for accounting rate of return, dollars for net present value, and percent for internal rate of return. Strengths of each of these. Payback period is easy to calculate, and we can compare. But the limitation is we don't have time value of money, and it ignores the cash flows after the payback period, right? Accounting rate of return, easy to understand and allows comparison. Again, ignores time value and ignores the different cash flow years, or the different years of annual rates. Net present value and internal rate are the best. The great thing about net present value is it shows the dollar value and shows the risks over the project's life, which is very helpful, but it's difficult to compare dissimilar projects, right? So if I have a project that's $1 billion and a project that's $100,000, the net present value is not going to give me a useful decision matrix. Internal rate of return allows me to make that decision matrix. So I'm going to buy a $100,000 home or $1 million home. It's a different decision for net present value, but the internal rate of return lets me compare those two net present values. So we want to use all of these in order to evaluate the project. And then afterwards, we have something called a post-audit or post-mortem. We determine how accurate were our calculations and if our decisions were correct. And so the same method used to support the capital budgeting decision should be used post-mortem, post-audit, to identify if we're making good investment decisions. So there's this concept break-even time. So this break-even time concept, I didn't make a slide for, let me see. I added a slide here, but I think I'm just going to talk about it. So all this thought is we're incorporating the time value of money into the payback period. So instead of we can figure out the present value of cash flows for each year, and then figure out the payback period based on that net present value of cash flows. I'm not going to ask you to do this on tests or exams. I don't think this is used much, because if you're going to go to the present value of cash flows, you might as well just use the other metrics. But just be aware this exists. And then we talked about using they said Excel, but Google Sheets uses the same software. So that's it for net present value. I'm going to spend this next portion, I'm going to open it for questions, and then I'm just going to show you how you can do your own retirement or plan how much money you'd need to save for retirement based on this methodology. So I'm going to open up for questions, and then I'll do that. I'll change this to retirement planning. 6 retirement. And then we'll end class probably around 11.